The used car market isn't just cooling, it's in freefall, right now. J.D. Power reports that 3.6 million excess vehicles are about to flood dealership lots nationwide, and it's happening faster than anyone predicted. Prices are dropping every single week. Most consumers will lose thousands, but a few smart buyers will score once-in-a-generation deals. Michael paid $47,000 for a 3-year-old SUV last summer. Today, that same model is listing for $33,000. That's $14,000, gone, vanished from his net worth. This isn't random market forces. It's a calculated disruption that's rewired how used cars are bought and sold. And traditional dealers simply can't compete with the Carvana playbook. In the next few minutes, you'll see exactly what's happening, why it was engineered, and how to protect yourself in what's quickly becoming the biggest automotive wealth transfer of the decade. This isn't a temporary dip that will bounce back. It's structural. We're not just seeing normal depreciation. We're witnessing a fundamental market correction triggered by multiple factors colliding at once: skyrocketing interest rates, record-high vehicle prices, and a massive inventory mismatch. The average used car payment has ballooned to $715 per month, completely detached from what average Americans can actually afford. And Carvana just lit the fuse on this powder keg. The entire used car ecosystem was already teetering, but nobody wanted to admit it. Dealers kept prices artificially high. Banks kept approving questionable loans, and consumers kept making financial decisions based on a market that was built on sand. Now the foundation is crumbling. So why did no one warn you this was coming? Because too many powerful players had too much money at stake to sound the alarm. The warning signs were there for anyone paying attention, but most people weren't. And now we're all about to witness the most dramatic reset in automotive retail history. Let me walk you through exactly what's happening behind the scenes. Let's start with the money. Today's prime auto loan rates are hovering around 8.2%, nearly double what they were just 3 years ago. For subprime buyers, we're talking 14 to 18% interest. Think about that. If you're buying a $30,000 used car with good credit on a 72-month loan, your monthly payment is now $535. The same car with the same down payment 3 years ago, $398 per month. That's a 34% increase in monthly costs, while real wages have barely moved. Cox Automotive analysts report that loan approval rates have plummeted 23% year over year. Banks are spooked. They see what's coming. Credit requirements are tightening by the week. Average down payments have jumped from $3,800 to $6,200 in just 18 months. The math simply doesn't work anymore. Daniel, a software engineer with a 740 credit score, was shocked when his loan application returned a rate nearly double what he expected. "I make good money, but these payments would be insane," he told us. "I'm walking away." Meanwhile, Melissa, with fair credit, was flat out denied for a loan she would have easily qualified for last year. But it gets worse. Banks aren't just raising rates and tightening standards, they're shrinking loan terms. The 84-month loans that became common during the pandemic, many lenders won't touch them anymore, especially on used vehicles. That's forcing buyers into shorter terms with higher monthly payments. And here's something almost no one is talking about. Captive lenders, the financing arms of major manufacturers like Ford Credit and Toyota Financial, are quietly pulling back from the used car market altogether, focusing their capital on new vehicle sales, where they can better control inventory and pricing. This credit contraction is happening at precisely the worst moment, when prices are still near historic highs, but beginning to fall rapidly. It's creating a perfect storm of affordability. The verdict is clear. Financing is freezing up, and without easy money, prices have nowhere to go but down. The floodgates have opened. There are now 3.6 million excess used vehicles waiting to hit the market. Let that number sink in. 3.6 million vehicles. That's more than the entire annual production of General Motors and Ford combined. Where are they all coming from? Rental car companies are dumping fleet vehicles faster than ever before. Over 780,000 rental cars will hit auction blocks in the next quarter alone. Companies like Hertz and Enterprise traditionally keep vehicles for 12 to 18 months before cycling them out. Now, they're unloading them after just 9 to 10 months. Why? Because they're seeing the same warning signs everyone else is, and they're racing to convert depreciating assets to cash before values collapse further. Lease returns? They're surging. Remember all those pandemic-era leases with inflated residuals? They're coming due, and no one wants to buy them at the predetermined values. Over 2.1 million leases will terminate in the next 12 months. Those cars aren't vanishing. They're heading straight to dealer lots and wholesale auctions. Many lease customers who would normally roll into a new lease are walking away entirely, shocked by the payment increases they're facing. Then there's the repo wave. Banks are now repossessing 13,800 vehicles every single day. Every single day. That's one car every 6 seconds being taken back by lenders. Mannheim auction data shows that wholesale values have already dropped 17% since January, with no bottom in sight. Black Book Analytics predict another 12 to 15% decline before year-end. But here's what makes this inventory tsunami different from previous market corrections. These vehicles aren't gradually trickling into the market. They're arriving all at once. Dealers typically maintain a 45 to 60-day supply of inventory. Right now, the national average is 93 days and climbing. Some brands and segments are approaching 120 days of inventory. The supply isn't just growing, it's exploding. And basic economics tells us what happens next. When supply surges and demand collapses, prices don't just dip, they crater. I've never seen anything like this in 22 years of selling cars. That's what Tom, owner of a mid-sized dealership in Ohio, told me last week. His floor plan interest, the daily cost of keeping cars on his lot, has doubled. He's now paying $43 per vehicle per day just to maintain inventory. Meanwhile, his days to turn has stretched from 42 days to a staggering 71 days. Do the math. That's an extra $1,247 in carrying costs per vehicle before it sells. J.D. Power reports that 42% of trade-ins are now underwater, meaning nearly half of potential buyers can't even get out of their current cars without rolling negative equity into new loans. And banks are increasingly refusing those deals. The average negative equity amount? $5,400. That's money that has to come from somewhere, either from the customer's pocket or from dealer profit margins. Neither option is sustainable. We're caught in an impossible situation, says Jennifer, used car manager at a multi-brand dealership group in Texas. We have to keep lowering prices to move inventory, but every price cut comes straight out of our already thin margins. Meanwhile, the cars we took in trade last month are worth less than what we allowed for them. We're losing on both ends of every transaction. The numbers tell the story. According to the National Automobile Dealers Association, the average dealership's used vehicle department profit has plunged 68% compared to last year. For many dealers, used cars have shifted from their most profitable department to a liability. And the downward spiral is accelerating. As dealers cut prices to move aging inventory, they create comps that drag down values for every similar vehicle in the market. This forces competitors to match or beat their prices, creating a race to the bottom that destroys profitability for everyone. Small and medium-sized independent dealers are being hit hardest. Without the cushion of new car operations or manufacturer incentives, Many are facing existential threats. Industry analysts predict that up to 20% of independent used car dealers could close their doors in the next 18 months. Even the big players aren't immune. AutoNation, the country's largest dealer group, reported a 45% decline in used vehicle gross profit in their most recent quarter. CarMax, long considered the gold standard in used car retailing, saw same-store sales drop 14.7%. Dealers are caught in a vicious cycle. They can't sell cars fast enough, their inventory costs are skyrocketing, and they're forced to slash prices just to move metal. The profit margins that sustained dealerships for decades are vanishing overnight. This isn't a slowdown. It's an existential threat. Let me explain something most consumers never see: the hidden financial machinery that powers dealerships. Almost no dealer owns their inventory. Outright, they finance it through what's called floor plan lending, essentially a giant credit line secured by their vehicle inventory. It's how a medium-sized dealership can stock $5 to $10 million worth of cars without that much cash on hand. But here's the catch. Floor plan isn't free. It's usually prime rate plus 1 to 2%. And that rate has more than doubled in the last 2 years. For decades, dealers operated on a predictable model. Buy cars at wholesale, mark them up 10 to 15%, sell them within 30 to 45 days, and repeat. The floor plan interest was a manageable expense built into their pricing structure. That model is now broken. With inventory sitting for 70-plus days, floor plan interest is eating dealers alive. Every day a car sits unsold, it costs more money. And unlike a mortgage or car loan, where the payment is fixed, floor plan interest compounds daily on the full amount. Then there are curtailments, mandatory principal payments on aging inventory. Most floor plan agreements require dealers to start paying down the principal on vehicles that remain unsold after 90 to 120 days. These payments can be substantial, often 10% of the vehicle's value every 30 days until it's sold. We had to write a $187,000 curtailment check last month, says Robert, CFO of a dealership group in the Southeast. That's cash straight out of our operating account for cars that aren't selling. We can't sustain that for long. The floor plan squeeze is forcing dealers into increasingly desperate measures. Many are wholesaling aging inventory at a loss just to avoid curtailment payments, which floods auctions with even more supply, further depressing prices. Others are cutting staff, eliminating marketing budgets, or taking on personal debt to keep their businesses afloat. The worst part? There's no easy escape. Selling at a loss hurts. Not selling hurts more. It's a slow-motion financial trap that sprung on thousands of dealerships nationwide. Enter Carvana. And this is where everything changes. Carvana didn't just disrupt the market. They fundamentally rewrote the rules of used car retailing. While traditional dealers were stuck in their decades-old business model, Carvana built something entirely different. Their algorithmic pricing model constantly analyzes millions of data points, adjusting prices in real time. Traditional dealers simply can't match this dynamic pricing capability. Carvana's direct-to-consumer acquisition strategy bypasses auctions entirely, cutting out the middleman and creating price pressure that ripples through the entire market. Their vertical integration, from acquisition to reconditioning to financing to delivery, eliminates the inefficiencies that traditional dealers relied on for their margins. And now they've reached critical mass. With over 120,000 vehicles in their ecosystem, they can undercut, outmaneuver, and outlast the competition. Sarah, a loan officer at a regional bank, confirms what dealers are seeing. Applications for Carvana. Purchases have doubled, while traditional dealer applications are down 30%. Consumers are voting with their wallets. But Carvana's impact goes deeper than just stealing market share. They've fundamentally changed consumer expectations about how car buying should work. The transparency, the no-haggle pricing, the door-to-door delivery, the 7-day return policy. These aren't just conveniences. They're complete rebuttals to the traditional dealership model that's remained largely unchanged for 75 years. And consumers have noticed. According to Cox Automotive's Car Buyer Journey study, 81% of consumers now say they want at least part of the car buying process to happen online. 65% want to complete the purchase without ever visiting a dealership. This is a generational shift in consumer behavior, and it's happening right as dealers are most vulnerable. Carvana's business model is purpose-built for this new reality. Their entire infrastructure, from their website to their reconditioning centers to their glass towers, is designed around digital-first car buying. Traditional dealers are trying to bolt digital capabilities onto a physical retail model that was designed for a different era. It's like comparing Amazon to a mall store that added a website. The most alarming part? Carvana doesn't need the same margins that traditional dealers do. They're playing a different game entirely, one focused on volume, data, and market share, rather than per-vehicle profit. This isn't competition, it's disruption, and for traditional dealers, it's becoming extinction. There's another dimension to Carvana's market impact that few people understand: information arbitrage. In the traditional used car market, information asymmetry was a feature, not a bug. Dealers knew what cars cost at wholesale. They knew which vehicles had hidden problems. They knew which models held value better than others. Consumers didn't. That information gap was worth thousands of dollars per transaction. Carvana's model systematically eliminates that advantage. Their algorithm knows exactly what similar vehicles are selling for nationwide, not just in your local market. It knows which features command premiums and which don't. It knows precisely how much each additional mile of odometer reading affects value. And most importantly, it shares much of this information directly with consumers. This transparency is a double-edged sword for the market. On one hand, it creates more efficient pricing. A vehicle's actual market value becomes more visible to everyone. On the other hand, it compresses margins by exposing the markup that dealers traditionally relied on. But the real game changer is Carvana's ability to operate across geographical markets simultaneously. A traditional dealer buys and sells in their local market. If SUVs are hot in Denver, but sedans are struggling, that's their reality. Carvana, however, can buy sedans in Denver, where they're cheap, and sell them in Miami, where they command higher prices. This national arbitrage capability creates an entirely new economic model that local dealers simply cannot replicate. They're playing chess while we're playing checkers, admits Frank, a dealer principal with 3 locations in the Midwest. If a particular model isn't selling well in my market, I'm stuck with it. They can instantly shift it to wherever demand is highest. The result? Carvana can afford to pay more for desirable trade-ins while charging less for retail units, a competitive advantage that traditional dealers cannot match without sacrificing already thin margins. And as their volume grows, so does their data advantage. Every transaction makes their algorithm smarter, widening the gap between their capabilities and those of traditional retailers. This isn't just market share they're taking. It's market control. Here's where it gets personal for you. If you bought a car in the last 3 years, there's a 42% chance you're underwater right now. Your loan balance exceeds what your vehicle is actually worth. And it's getting worse every month. That crossover SUV that seemed like a reasonable purchase at $45,000? It's now worth $37,000 and falling. With average rates, you're still carrying over $41,000 in loan balance. You're trapped. Can't trade it in. Can't sell it privately without bringing thousands to the closing. Can't refinance because the loan-to-value ratio is upside down. The wealth destruction is happening in real time, silently eroding the balance sheets of millions of American households who thought they were making safe, conservative purchases. For perspective, the average negative equity amount has reached $5,400. During the 2008 to 2009 automotive crisis, it peaked at $3,600. We're already 50% higher than the worst of the Great Recession. And the gap is widening. Vehicle depreciation is accelerating while loan amortization remains constant. The result is a growing negative equity bubble that will take years to deflate. The worst cases are with longer-term loans on rapidly depreciating vehicles. Take James, who financed a popular American SUV for 84 months in 2022. After 2 years of payments, he still owes $39,000 on a vehicle now worth $27,000. That's $12,000 underwater, with 5 years of payments remaining. I feel like I'm in quicksand, he says. Every payment barely covers the interest. Meanwhile, the car keeps losing value faster than I can pay it down. This negative equity trap isn't just a personal finance problem, it's becoming a systemic risk to the automotive ecosystem. When consumers are underwater, they can't re-enter the market. They can't trade up, trade down, or even make lateral moves to different vehicles. They're stuck, often in vehicles they can barely afford to keep. This immobility freezes the entire market. New car sales suffer because trade-ins disappear. Used car inventory stagnates because consumers can't move out of their current vehicles. The entire cycle of automotive commerce that the industry depends on begins to seize up. And here's the kicker. This will get worse before it gets better. Much worse. As values continue to fall, more owners will slip underwater. More will find themselves locked into vehicles they can't afford to keep but can't afford to sell. And the negative feedback loop will intensify. There's another factor accelerating this market collapse that almost no one is talking about: the technological obsolescence curve. Today's vehicles are essentially computers on wheels. The average new car contains more than 100 million lines of code, more than a commercial airliner. And like all technology, they're subject to the same rapid obsolescence cycle as your smartphone. Features that were cutting edge 3 years ago are now standard. Infotainment systems that seemed impressive in 2021 look dated compared to today's offerings. Driver assistance technologies are evolving at breakneck speed. This technological churn is creating a new form of depreciation that traditional valuation models aren't equipped to handle. We're seeing late-model luxury vehicles lose value not because of condition or mileage, but because their tech packages feel 3 generations behind, explains David, an automotive analyst specializing in residual values. A 2021 vehicle with a 2020 designed infotainment system feels like ancient history compared to what's hitting showrooms now. This technological depreciation hits hardest at the top of the market. Premium vehicles where tech features command significant price premiums when new. A $5,000 tech package on a luxury SUV might retain only 20 to 30% of its value after just 3 years, compared to 40 to 50% for mechanical components. And as automotive technology continues its exponential advance, particularly with semi-autonomous driving features and connected car capabilities, this form of depreciation will accelerate. Consumers are becoming aware of this technology gap and adjusting their purchasing decisions accordingly. Why pay premium prices for 3-year-old technology when leasing or financing a new model provides the latest features for similar monthly payments? This shifting consumer calculus is creating another headwind for used vehicle values, particularly in the $30,000 plus segment where technology expectations are highest. And it's happening right as Carvana's market disruption is gaining maximum momentum. So who gets crushed in this market collapse? If you're underwater on your current vehicle, you're facing an extended period of negative equity. You're paying for depreciation that's already happened. If you're a dealer without a digital-first strategy and efficient inventory management, you're fighting for survival against a model designed to make you obsolete. If you recently paid cash for a late-model used vehicle, You've just purchased a rapidly depreciating asset at its historical peak. If you're dependent on automotive lending, banks, credit unions, and captive finance companies, you're watching your portfolio quality deteriorate in real time as collateral values plummet below loan balances. If you're an automaker, you're facing the prospect of a used car collapse that inevitably drags down new car prices and residual values, compressing margins across your entire business. The casualties will be widespread and severe, but there are winners in every disruption. Cash buyers with patience will find incredible deals in the next 6 to 12 months. Our analysis suggests the market bottom will hit between November 2025 and February 2026. Consumers who can wait to purchase will see price drops of 25 to 35% on many popular models compared to their 2023 highs. Counter-cyclical shoppers, those looking at sedans and economy cars, while everyone else chases SUVs and trucks, will find exceptional value. Strategic trade-down buyers, those willing to sacrifice size, features, or brand prestige for affordability, will navigate this market collapse successfully. And of course, Carvana and similar digital-first retailers will emerge stronger, with increased market share and an accelerated timeline to profitability as they capitalize on traditional dealers' weaknesses. The automotive landscape that emerges from this collapse will look fundamentally different than the one we've known for generations. The dealers that survive will be those who adapt fastest to the new reality, embracing digital channels, transparent pricing, and operational efficiency. For consumers, the long-term outcome may actually be positive: a more efficient, transparent marketplace with realistic pricing and less information asymmetry. But the transition will be painful for millions of vehicle owners caught in the collapse. What makes this market collapse particularly frustrating is that the warning signs were visible for years. This isn't a black swan event. It's the inevitable consequence of market forces that industry insiders chose to ignore. The pandemic-era price surge was always unsustainable. When used car values jumped 42% in 18 months, that wasn't a new normal. It was a bubble, plain and simple. The explosion of 84-month loans should have been a red flag. When banks start extending terms to make payments affordable, they're not doing consumers any favors. They're masking fundamental affordability problems. The proliferation of negative equity should have sounded alarms. When dealers and lenders routinely roll $3,000, $5,000, even $10,000 of underwater loans into new financing, they're not solving problems. They're compounding them. The surge in vehicle size and price should have raised concerns. When the average transaction price for a used vehicle jumps from $19,000 to $30,000 plus in 5 years, that's not progress. It's a market disconnecting from economic reality. These warning signs were obvious to anyone paying attention. But the industry had every incentive to keep the music playing as long as possible. Dealers enjoyed record profits on inflated vehicle prices. Banks collected larger interest payments on bigger loans. Automakers benefited from artificial scarcity that let them prioritize high-margin vehicles. The party was too good to end voluntarily. So now market forces are ending it involuntarily and violently. The market correction we're witnessing isn't just inevitable, it's necessary. Used vehicle prices had become completely detached from economic fundamentals. A reset was coming, one way or another. The question isn't whether prices will fall, but how far and how fast. Our analysis suggests a 28 to 35% peak-to-trough decline for the overall market, with some segments experiencing even steeper drops. Late-model luxury SUVs and full-size trucks, the segments that saw the most dramatic price inflation, could see 40% plus declines from their pandemic peaks. The timeline? We're currently about one-third of the way through the correction. The steepest drops will likely occur over the next 4 to 6 months as rental fleet disposals, lease returns, and repossessions flood the market simultaneously. We expect the market to find its bottom in late 2025 or early 2026, with a slow recovery beginning mid-2026. But don't expect prices to return to their 2022 to 2023 highs. The new normal will likely settle 15 to 20% below peak levels on an inflation-adjusted basis. That's not a temporary dip. It's a fundamental reset. This market reset isn't something you can ignore. You need a plan. If you're currently shopping, wait if you possibly can. Every month you delay will likely save you thousands. Get pre-approved financing before shopping. The loan market is tightening daily. Focus on models with traditionally strong resale value. They'll depreciate less in percentage terms. Consider certified pre-owned vehicles with manufacturer warranties. They'll provide some protection against technological obsolescence. Look at overlooked segments like sedans and hatchbacks, which are seeing steeper price drops than SUVs and trucks. Negotiate aggressively. Dealers are increasingly desperate to move inventory. Check multiple sources. The pricing disparity between platforms is widening. What costs $28,000 at one dealership might be $25,000 elsewhere. If you're underwater, keep making payments. Defaulting will devastate your credit for years. Consider gap insurance if you don't already have it. Calculate your negative equity precisely. Then make a plan to pay it down faster than your car depreciates. Explore refinancing options. Even with negative equity, you might qualify for a lower rate that could help you catch up to the depreciation curve. If you're severely underwater and struggling with payments, contact your lender proactively. Many have hardship programs that can provide temporary relief. As a last resort, consider voluntary surrender rather than waiting for repossession. It's marginally better for your credit score. If you're selling, do it now, today, this week. Values are dropping weekly. Consider direct sale platforms, including Carvana, to get competitive offers quickly. Be realistic about your car's value. The price you paid is irrelevant in today's market. Detail your vehicle professionally and fix minor issues. Presentation matters more in a falling market. Gather service records and documentation to prove maintenance history. Be prepared to negotiate, but know your absolute minimum acceptable price before starting. If you're a dealer, accelerate inventory turn at all costs. Aged units will only get more painful. Cut overhead immediately. The margin compression isn't temporary. Invest in digital retail capabilities. It's no longer optional. Diversify your inventory mix toward affordable vehicles under $20,000. Build service department capacity. In market downturns, repair and maintenance become crucial profit centers. Consider strategic partnerships with digital retailers rather than trying to fight them directly. The dealer landscape won't just be reshaped by this collapse. It will be fundamentally transformed. Industry analysts predict that up to 20% of dealerships could close or consolidate in the next 24 months. The survivors will be larger, more digitally savvy, and less dependent on traditional profit centers. We're already seeing early signs of this consolidation wave. Publicly traded dealer groups are acquiring struggling independents at fire sale prices. Private equity firms are circling distressed dealerships, looking for bargains. And manufacturer-backed consolidation initiatives are encouraging smaller dealers to sell to larger groups. The mom-and-pop dealership model that dominated automotive retail for generations is rapidly becoming extinct. In its place, we'll see fewer, larger retail groups with sophisticated digital capabilities and economies of scale that smaller operators simply cannot match. This consolidation will eventually stabilize the market. Fewer dealers mean more rational pricing and inventory management. But the transition will be brutal for thousands of dealership employees, particularly at smaller operations that lack the resources to weather the storm. In our next video, I'll break down the exact models seeing the biggest price drops, where to find them, and the step-by-step negotiation strategy that's working in today's broken market. Hit subscribe so you don't miss it. Your financial future might literally depend on it. This isn't just another market cycle. It's a reset. And now you know exactly what's happening and how to protect yourself. Remember, in every market collapse, there are victims and there are victors. The difference isn't luck. It's information and timing. And now you have both.